Let's dive right into this explainer on Warren Buffett's timeless investing rules. Today, we're completely cutting through the absolute chaos of modern finance to uncover the incredibly disciplined and, yeah, sometimes almost boring philosophy that built a literal billion-dollar empire. Forget everything you've been told about frantic stock trading, because we're going to look at how the Oracle of Omaha transformed a tiny investment partnership into Berkshire Hathaway using a strategy that'll absolutely change how you view your money.
So think about the two totally different financial worlds we live in right now. On one side, you've got modern markets driven by pure anxiety. Social media hyping up rapid day trading, practically pushing you into making super stressful, highly emotional decisions. But Buffett's approach? It is the exact opposite. It's calm, it's rational, and it completely ignores the hype. He just focuses on buying outstanding businesses at reasonable prices and then holding them for decades. One path is basically a one-way ticket to burnout, while the other actually leads to lasting wealth.
To get a grip on this, here is our roadmap. We'll cover Lesson 1, what to buy, Lesson 2, how to act, Lesson 3, wealth habits, and we'll wrap it all up with your long-term playbook. All right, starting right off with Lesson 1, what to buy, focusing on his rules 1, 2, and 5.
It all begins with a concept called your circle of competence. And look, this is an absolutely non-negotiable rule for Buffett. You invest only in businesses whose products and competitive advantages you fully 100% understand. Whether your expertise is in healthcare, tech, or just retail, you have to stay in your lane. Seriously, if you can't explain exactly how a company makes its cash to a 5-year-old, you have absolutely no business investing in it.
Picture the late 1990s. Everyone and their neighbor was rushing into these shiny new internet companies, getting rich on paper without having a clue about the underlying business models. And Buffett? People actually mocked him for missing out. But he stayed completely away because those speculative stocks were way outside his competence, and frankly, they lacked actual profits. When the bubble inevitably burst, that stubborn discipline protected his investors from total ruin. In this case, being boring literally saved billions.
Which brings us to a massive point. Buy wonderful companies at fair prices instead of mediocre companies at cheap prices. Searching the bargain bin, honestly, it's a total rookie mistake. Just look at Buffett's massive investment in Apple. He didn't buy in because it was cheap. He bought it because he saw an impenetrable brand, fiercely loyal customers, and just immense cash flow. Over the long haul, quality is always going to outperform a short-term bargain. But even with those wonderful companies, you have to demand a margin of safety. Think of this as your portfolio's financial shock absorber. Because literally no one can predict the future, you have to aim to buy a quality business at a discount, meaning below its true intrinsic value. That way, if future earnings stumble, that built-in discount protects your capital. It's all about patience here. You simply wait until the market hands you the right opportunity. He played this beautifully back in the 1960s with American Express. A major financial scandal hit, the market totally panicked, and they dumped the stock. But Buffett actually did his homework. He realized the core brand and the customer trust were still completely intact. He capitalized on the market's temporary panic because he understood the crucial difference between a short-term crisis and a permanently broken business. And, well, the rest is history. Moving right along to Lesson 2, how to act, covering rules 3, 4, 6, and 10. When it comes to acting, the psychology of time is your absolute greatest asset. Buffett famously said, "Our favorite holding period is forever." Now, obviously, he doesn't hold literally everything forever, but adopting this mindset is your ultimate defense mechanism against yourself. It stops you from frantically trying to time the market, it drastically cuts down your tax bills, and it eliminates emotional, impulsive selling. Remember, time, not timing, builds wealth. Take Coca-Cola, for example. By patiently holding this stock since the late 1980s, Buffett simply let the company's global expansion do all the heavy lifting for him. He didn't panic sell during recessions. Nope, he just sat back and allowed Berkshire Hathaway to reap the rewards of rising share prices and what is essentially a literal waterfall of compounding dividend income over decades. And that patience brings us to the ultimate antidote for herd mentality. Be fearful when others are greedy and greedy when others are fearful. It sounds so simple, right? But it is incredibly hard to actually execute. During a bull market, amateur investors get super greedy and they overpay. During crashes, they panic and sell off quality assets at rock-bottom prices. Buffett's rule demands that you do the exact opposite. Think about the 2008 financial crisis. There was absolute blood in the streets. While everyone else was liquidating their portfolios in pure terror, Buffett went shopping. He systematically deployed billions into outstanding companies at generational discounts.
Because he knew the economy would eventually stabilize, those investments generated staggering returns for him. A market crash isn't a disaster at all. For the disciplined investor, it's basically a massive clearance sale.
So to master your emotions when things get crazy, you must stop obsessing over daily stock charts and just ask yourself this one grounding question. Has the long-term value of this business changed? That's it. People lose absolute fortunes chasing trends or selling out of fear. If you can accept that daily price volatility is just noise and stay completely focused on the business's fundamental value, you're going to keep your head while everyone else is losing theirs.
Okay, let's look at Lesson 3, Wealth Habits. This covers Rules 7, 8, and 9.
Look, strategy means nothing without the right habits. And Buffett warns that your very first order of business has to be entirely defensive. You must eradicate high-interest debt, like carrying a credit card balance with a 22% interest rate. This isn't just good advice. It's the absolute bedrock prerequisite to building wealth.
Just think about the pure math for a second. If your investments are earning, say, a really solid 10% a year, but you are paying 22% on a credit card, you are actively burning your own money. The math is ruthlessly working against you. Eliminating that expensive debt is literally the only guaranteed, risk-free return you're ever going to get. Seriously, do not invest a single dime until that fire is put out.
But once you are debt-free, compound interest suddenly becomes your best friend. Consider two investors here. Emily starts early, investing $300 a month from age 25 to 35, and then she never invests another penny, ever. Now David, he waits until age 35, but then he invests $300 every single month until he retires. Astoundingly, Emily often ends up with more wealth. Why? Just because her money had a whole decade longer to compound. Again, time in the market is vastly more powerful than timing the market.
Now, keeping that financial edge requires continuous learning. Did you know Buffett reportedly spends up to 80% of his entire day just reading? It's true. He devours annual reports, industry publications, financial statements, you name it. The markets evolve, and by treating knowledge as a compounding asset itself, you ensure your decisions remain razor-sharp no matter what the economy throws at you.
And finally, let's bring it all together with your long-term playbook.
You know, the fastest way to dramatically improve your returns isn't actually about finding some secret hidden stock. It's simply avoiding these toxic mistakes. Stop trying to get rich quick. Unfollow the social media hype entirely. Stop the frantic day trading. Don't sell just because a news headline scared you. And whatever you do, never invest the rent money you're going to need next month. Dodging these landmines is exactly how the professionals win.
So here is your definitive 3-step framework. Step 1, eliminate high-interest debt and stash away an emergency fund. Get that defense locked in. Step 2, invest in what you know. Or if you want to keep it super simple, just buy broad market index funds. This lets you own a slice of the entire economy while minimizing your risk. And step 3, be aggressively patient. True wealth is rarely built overnight. It's forged through relentless, boring consistency. So, as you look at your own portfolio today, I want you to ask yourself one final, pretty brutal question. Are you gambling on tomorrow's fleeting headline, or are you actually architecting a financial fortress for your long-term future? The Oracle of Omaha has given us the blueprint. The only question now is, do you have the discipline to follow it?